So let me briefly give you an idea what the National Center for Financial Education does. National Center for Financial Education is a body which spreads financial education across the country. The focus is schools and college, but at the same time we also do a lot of content writing. We engage with principals of schools. 2 months back we had a function in Bhubaneswar where around 100 principals of different schools and colleges from across the country were here. The idea of engaging with principal is we want to use them as multiplier. If one principal agrees to participate in the financial education program, automatically 5,000, 6,000 children get covered by it. So National Center has three main areas in which it works. One is it does a survey every 5 years on the status of financial literacy and inclusion in the country. I must say that Odisha, which has around 76% literacy, the financial literacy is only 8%. It's 8%, where the national average is around 22%. And that is why the role of institutions which Mishra ji is running becomes much more important. Even if we break up basic financial education into knowledge, behavior, and attitude, knowledge levels in Odisha is very, very low as far as financial products are concerned, financial institutions are concerned, and the basic financial concepts are concerned. So we would like to associate as much as possible with institutions, and there is a program for school education which we call as Money Smart Schools. Any school can approach us on our website, ncfeindia.org, get themselves registered there that they want to become a Money Smart school. And then NCFE has 3 specific programs. We provide them content. This is between class 6th and class 12th. We provide free 2 days teachers training program for that school. And we also hold examinations of the modules of the financial literacy content for that school for at least a year, free of cost. At the end of the year, once the children have gone through the financial literacy module, we also certify the school as a Money Smart school. Mishra ji, if you want to work in that space, you can join with any school you want, and we can convert it into a Money Smart school through your help. Secondly, we do a national level financial literacy test. This test is in 3 divisions, class 6 to 8, 9th, 10th, and 11th, 12th. This financial literacy test every year is conducted 24/7. Now it is 24/7. First 3 years we used to have it on specific dates. Since it's an online test, it is 24/7. And only for the offline, we have 1 week window in a year where schools can take the test offline. Close to 4 lakh children take this test today. It is comprehensively handled by NISM, and 5,000 schools participate in this test. It is the biggest financial literacy test across the globe. And then we have this website which I had made a mention, ncfeindia.org. It is the biggest website in the space of financial literacy and inclusion. It gets much more hits annually than all the regulators put together. The hits on this gives us some comfort that people are following us and are downloading material from this. Every material can be downloaded from this website, and it is a very comprehensive website with videos, with content on all the 4 sectors. Last 2 years, we have started devoting our time on training of the trainers. In fact, Manabendra was making a mention of financial literacy counselors of banks. NISM is the biggest player in this space for providing training to financial literacy counselors, and then they take this forward in their centers of financial literacy. But we are one of the biggest resource for training of the trainers in the space of financial literacy. I would recommend, because now it's actually got converted into a conclave with the number of people which we have, and bulk of the people are people who act more as resource or advisors in this space. The challenge is, how can we create content, train the trainer or the teacher, and then conduct examination in that space. If we are able to do all the three in a sequential manner, then it becomes much easier for any school or college to absorb it. For the professional colleges, we run a program, especially those colleges like engineering and management schools. We run a program known as the first paycheck. When you get your first paycheck, what are the thoughts which should come to your mind, which will make you a good financial planner in the future? And that is a very, very popular program. We do around 200 programs every year for different professional colleges. And we also run one general program for commerce colleges known as FACT, Financial Awareness Consumer Training. This is a 2.5 hours module, and which provides enough guidance how to handle credit cards, how to handle your student's loan. Both of them are big areas of concern, especially the credit cards, because you see, when you get your credit card bill, I have not been able to decide, or I have not been able to decipher why the banks don't put their foot down, that when you get your credit card bill, there is a clause of minimum payment. But the interest on the remaining amount is on the 4th page in very small letters. Normally, you don't even go to the 4th page. Why don't we make it mandatory that where there is this minimum clause, below that only there would be an asterisk, and there should be a mention what would be the interest on the remaining balance when you pay the next month. But that is the bread and butter of credit cards, and hence it is on the 4th page, which normally you don't even go to. And even if you go to, there is all likelihood of missing it. Similarly, insurance, it is one of the most missold products in the country, but we have nothing to do with it. When you get your first paycheck, the only insurance which you should be looking at is a term insurance. But you are always sold an endowment policy, a money-back policy, a policy which encourages saving, or a policy which is equity-linked. Actually, the day you get your pay, if you buy a term policy of 50 lakhs or 1 crore, it costs you approximately 15 to 25 rupees a month to service that. But by and large, we are sold a policy. In fact, in the principals conclave in Bhubaneswar, we met a principal who had 60 policies and did not know what to do with it. And I told him, I was very upset, how can a principal be, and none of them were term policies. They were all equity, savings, tax. So I said, at least whenever you get an opportunity, the person who sold you that policy, you can give him a slap or two. So he said, I can't do that because most of them have been sold by my nephew, niece, and sometimes brothers or sisters. Because when you sell those other policies, your commission rate is close to 30-35%. And when you sell a term policy, your commission is only 3 to 4%. So there is a big challenge And these are some basic things which we want to bring to light to the students. Presuming that if one generation of students get educated, automatically the cycle of education would become much more richer. Today we are in a position with this platform of, as they call it, JAM, Jandhan, Aadhaar and Mobile. They are coming together, and it provides us an opportunity to provide a huge amount of comfort in the space of financial education, taking this platform into consideration. So I'm very happy, Mishra ji, for having me here, for sharing some thoughts, and also to have the minister here, who has shown in his initial response a reasonable amount of work which we can jointly do in the space. MSME is a very big space, and if financial education, in fact, recently it will be coming out in the next 1 week. We have written a book from NISM on financial education to the MSME sector. And you will, may want to, I'll send it to you, you may want to present it to the minister and seek larger association, as he's very keen to do so. So NISM is a one-stop for any activity in the space of financial education. And the good part of NISM is we don't charge any money in imparting, because the budget is provided by the financial sector regulators to the NISM. We have a budget of around 6-7 crores a year, and that whole budget is used in disseminating basic financial education throughout the country. Thank you very much for having me here.
Thank you, Sandeep ji. Really, under the leadership of the Sandeep ji, NISM and NCFE, National Institute of Security Market, and National Center for Financial Education, doing a tremendous job. And we have read the basic books also, very nice and interesting. So we thank Dr. Sandeep ji for, and we'll have ongoing coordination in future. Now, with this panel, we have got a panel discussion on banking and capital market next. And I invite Mr. P. Krishnamurthy and Dr. K.C. Mishra. The third panelist is yet to come, but we'll start with this. Mr. Krishnamurthy, please. Dr. K.C. Mishra.
Thank you, Mishra. It's nice to be amidst the student. As we have been talking on financial inclusion and financial literacy, there are different domains in the financial landscape. We have got banks. In the banks, there are different segments. And then capital market players. Then one more of that is the non-banking finance companies. I'll just give some idea about these non-banking finance companies. They are all, to begin with, they were of different forms, different legal structures, and they were trying to lend money to the borrowers. That's all. But one thing they were doing is they were collecting deposits. And the rate of interest they charged were not subject to any kind of regulations. And there were no discipline on the deposits which they were accepting. And this resulted in huge problem in the sector. And the deposits collected were invested in different avenues, speculative avenues, and ultimately the depositors started losing money, and the losses were quite substantial. And when suddenly this losses aggregated, number of units, companies which are failing increased, the regulator stepped in. And then they started restructuring the whole segment of non-banking finance companies. The word non-banking finance company, many times I myself wondered, though I was running the department. They could have called finance companies also. Non-banking, see, they do not undertake the core functions of banking. That's the only issue about it. To identify them, they are called as non-banking finance companies. They do not come under the regulation of banking, and there is a separate regulatory aspects for that. Now, over the period of time when they started regulating them, the whole issue was very simple. How to protect the interest of the depositors. That is a key regulation. If you want to regulate, you want to protect the interest of the depositors, the basic thing is that the institution which is accepting the deposit must be financially strong. And not only financially strong at one point of time, it must be sustained over a period of time so that the depositors' money are intact. This is the basic theme which we adopted in regulating the non-banking finance companies. The first step we started was they must all be registered with the Reserve Bank of India. If you are not registered, you cannot be in the business domain. And once this registration started, we weeded out hundreds, rather thousands of companies, and the numbers came down. And then wherever they were accepting deposits, we put conditions on that as to how much deposits they can accept. And they were subject to inspections. And slowly, we started giving registration for new companies with the condition they cannot accept any more deposits. So there came a system where companies which can deposit and continue, but no more new deposit accepting companies. So we segmented it. And we allowed it that, and we are monitoring only the deposit-taking companies. There was no regulation, much regulation for non-deposit-taking companies. But they started growing in size. They were accepting money in different forms. They were borrowing from banks. They were floating debentures. They were borrowing from other companies. They were going to the market to borrow. In other words, the public money was coming to them in different forms. Debentures, bank borrowing, bank money is public money. So the idea was that unless these financial institutions are sound enough, the lenders to them, whose money is basically from the public, cannot be strong. And therefore, we started regulating even the non-deposit taking companies. What exactly the regulations we tried to do? The regulations we tried to do was that they must have adequate capital, first. Second, they must have prudential norms for the assets they are having. And then we said there must be what is known as corporate governance. Since it is student, I want to make it much simpler. Corporate governance means a disciplined way of running the organization. It cannot be haphazard. It should be subject to some norm, rules and regulations. And then we also imposed conditions that they must submit periodical returns to the Reserve Bank of India. And in the assets, they must keep monitoring and reporting to us there is weakness. They must make provisions for that. In other words, slowly we started expanding the regulations for even non-deposit taking companies so that the financial system is not contaminated by weak companies. And those companies which are weak enough, Reserve Bank was not very keen on them to continue in the business. And then the number of companies being very large, we found that too much of regulations hampers the functioning of these companies independent of the size of that. So if there is a small company with 100 crores business and there is a company with 10,000 crore business, when you apply the same norms and provision, the small companies suffer. They cannot afford. Cost of regulation becomes more. And the risk to the system is not much. And we are not allowing them to accept deposits. Therefore, what we did was, we classified them as two segments, systemically important deposit-taking companies and systemically not important companies. We segregated them also. So came into picture deposits-taking companies, systemically important companies, and non-systemically important companies. And with these non-systemic banking and non-banking companies were subject to lighter regulations, not very rigorous regulation as in the case of systemically important companies. And even in these companies, we started classifying them. Those will have public interface and those do not have customer interface. And then those have borrowings and they don't have public funds. So we have finally, we have adopted a standard or method, the Reserve Bank adopted a method where apply the regulation depending upon the institution and not simply same for all. So this has facilitated easy functioning of that. But at the same time, the public interest has been safeguarded with reducing their deposit-taking activities. In the recent framework, Reserve Bank has said even the number of times they can accept deposit has been reduced. And this is in the backdrop of the Reserve Bank's pronounced policy that deposit accepting activity must be confined only to the banks and no other institution should be allowed to accept deposit. This is the regulator's view. And therefore, today, you can safely say that non-banking finance companies are much more safer and financially sound, and they do not pose threat to the depositors. The amount of depositors non-banking finance companies are holding is very, very limited, and therefore, starting from losing of money by a substantial number of people, today NBFCs have migrated to a point where they are quite safe and no depositors will be allowed to lose money. The second thing is, it was an unregulated domain, but today it is very much regulated. And the third one is, depending upon the size of that, the regulations are lighter or harder. And therefore, we have now got a clean system, so much so, you find there is a lot of interest shown by overseas investors to invest in these companies. We have provisions where there are a number of companies where foreign investors are holding stakes in that. And you can understand today that moving away from unregulated, rampant system to a very orderly and regulated system is a Herculean job, which the Reserve Bank has done over a period of, very short period of a decade. And this is the story of the evolution of the non-banking finance companies. Now, the advantage, why non-banking finance companies are very important in the sense, they are one of the important credit delivery channel. That means a credit purveyor, credit giver, apart from the banks. If you go into a commercial bank even today, despite all the talks we make, getting a loan from a commercial bank is not an easy job. It's very, very difficult for different reasons. Not that for they are wrong, for different reasons. But these non-banking finance companies are ready to take much higher risk than what normally a commercial bank is ready to take. And therefore, the credit availability becomes much more faster, not easier, much more faster. What they can, in some of the non-banking finance companies, if you see, they offer the credit in a matter of 4 days, 5 days, whether it's small loans or big loans. They give very fast. But the conditions are quite rigorous, and the rate of interest they charge may be slightly higher. There are no specific interest rate regulation for non-banking finance companies, unlike the commercial banks. Nevertheless, you find with the competition, the non-banking finance companies' rate of interest is all equally competitive, if not as good as commercial banks. And non-banking finance companies, the size of the assets are quite large. I mean, they say it's growing at 20% on an average, unlike the commercial banks, which their growth is faltering now, the past 1 or 2 years. And the domains in which they are lending has widened. They fund infrastructure, they fund retail, they finance SME. There is no area where they have not entered. And currently, the statistics reveal their presence in the retail market and SME segment is increasing. In other words, you can see NBFC is effectively started increasing their contribution towards financial inclusion. Retail sales, retail segment is a very important area where commercial bank retail segment getting the loan is quite difficult. And NBFCs have started SME sector in a very big way, and they are increasing their share. And now you cannot dispense them so easily as a dispensable segment. They are contributing significantly for this financial inclusion. In this context, 1 or 2 lending portfolios are there. If I tell you, you will appreciate their contribution. One area where they are dominant is financing the transport vehicles. Not only they finance new transport vehicles, but also they finance second-hand transport vehicle, single transport operator, 2 or 3. And this is a very, very important area to develop transport network in the rural and urban sectors, both. The other area where these NBFCs have taken a lead role is microfinance activity. As you know, microfinance is basically, the idea is to lend for the very small size loans to the villagers and rural sectors, small micro industries like that. And here they have done a great work by extending their presence across the country, and the number of clients they are having huge. And the contribution has been so significant. When Reserve Bank of India coined the idea of floating small banks, almost all the licenses Reserve Bank gave is to these microfinance companies. Now, many of these microfinance companies have now converted themselves into small bank finance, and they continue to do what exactly they were doing earlier, but the advantage is that they can mobilize deposits. They wanted to reduce the cost of funds, and therefore that provides an opportunity for them, and that microfinance activity of them continues to be the main share of their balance sheet, and they continue with that. And there was some problems in microfinance industry. In case of microfinance, when it started as a very noble cause for lending to the rural sector, weaker section. It started in a very, very nice way. But slowly they found that it became a source for making huge income. So much so, you will be surprised. Many of the overseas venture capitalists started taking shares, holding in these microfinance companies. They found that repayment rate was quite good. The tickets were very small. The risk was very well distributed. And they could charge any amount. There was no restriction on that. And they started charging any amount of interest. And this became a big problem. And slowly the murmuring started. One of the company which in Andhra, when they floated in equity, people were surprised how a microfinance company's share can be having so much premium. It started such a huge debate and discuss, and it became a political issue. I don't want to go and get into what exactly. And the government intervened, and that crippled that MFIs. And that cannot be allowed, and Reserve Bank stepped in and appointed a committee, and they brought specific regulation for MFIs. Basically, the regulation which brought out what looked at customer service. What they said was, first thing they brought in an element of interest rate regulation for MFIs. Second thing, they said what is the maximum amount of loan that you can give. Third is simultaneously how many loans you can give to them, and how many microfinance can at the same time finance them. In other words, microfinance companies started giving more and more loans to make them debt burden, keep getting the interest and rollover. With this, Reserve Bank cut it by saying that it must be need-based, it cannot be more than 2 institutions, not more than 2 loans, and the ceiling was kept. And the another thing they said was, if you are going to give a loan, if it is more than a particular amount, then the number of the period you will allow for them to recovery will be longer. So they created a very congenial environment for the small borrowers to borrow conveniently and without any stress or burden on their cash flows. Now, this is a very big achievement by the non-banking finance companies. They still survived and they did so very well. The number of microfinance companies increased, and many of them now become small banks. And the small banks are meant for mainly the focus is on financial inclusion supporting. So therefore, the NBFCs are migrated from purely speculative deposit taking and profiting and taking risky ventures to an organized, regulated domain. And this service of them is so important that they occupy a major segment of the financial system. But recognizing that they are growing so much and interacting with the different segments of the financial system, Reserve Bank wanted them to be financially sound, and the regulations are in place, which is constant. Now slowly they are enhancing the regulation so that it becomes almost at par with that of the commercial banks, with the lighter aspects being retained. So this is a sum and substance of the non-banking finance companies with the focus on microfinance. Even today, there are a number of microfinance companies which are running very profitably. There was a problem, I don't want to know or say what reason, in the past 1.5 years. 1 year, they had a problem on cash and many of them suffered, recovery suffered. Now, slowly many of them have overcome and they started making the balance sheet black and they have started reviving. So basically, what I would like to say, when we talk about financial inclusion, these non-banking finance companies are a very important component of this part. Here I stop it and I will leave it to... Thank you.
Respected all, my second innings. See, when Mishra ji, the great organizer and doing mammoth social work, he told me to speak on challenges of financial institutions, bank, insurance, etc. I thought it's just like ocean. And of course, there is an opportunity added to it, 2 oceans. Anyway, I'll not bring those 2 oceans here, but some telegraphic messages. So in the morning we were discussing about Sandeep was telling about that 8%, 76% literates in India, but 8% financial literates. You know, inclusion, we are talking of inclusion, this CRISIL, they created the famous index, inclusion index, that is Inclusix. And according to Inclusix, unfortunately, Eastern region inclusion is only 27%, whereas Southern region inclusion is more than 62%, and India's average is about 52%. And it has been found that inclusion and literacy, they are highly correlated, but the literacy is a fraction of always inclusion. That means even for the inclusive participants, there is a lot of need for retrofitting literacy, that is giving literacy from behind. But that is not all. There is a requirement. You see, the Inclusix of, I am a critic of Inclusix of CRISIL. The reason is, they have taken only 4 parameters, first 3 parameters, on demand they took 4 parameters for find out this, the financial inclusion. What are the parameters? The bank penetration, deposit penetration, credit penetration. They started with this, and they added insurance penetration at the 4th parameter. So these are all parameters of financial inclusion. And when these parameters are regressed, it is found often that there are no branches but there is better inclusion, and there are branches but there is no inclusion. And Odisha, you know, Odisha is having one of the, as Minister was telling, one of the poorest credit deposit ratio in Odisha. And all these things point out that these parameters are not having a very high correlation with each other. Where is the difficulty? The difficulty is at Committee for Household Financial Products. And I was reading the report of the committee, summary only, I have not read the entire report. I read about something called sandbox. They create a sandbox. For what? To get a pre-testing of the regulatory provisions that has got uncertainty for the regulator. You see, this is a little paradoxical. We have four major financial regulators, and these regulators will create the sandbox, and each regulator will allow the other regulator to imbibe from the sandbox and create its own regulation. Maybe that will reduce the top war. But if there is a regulatory confusion, if there is an uncertainty at a regulatory level, you think of the uncertainty at operational level and down the line, uncertainty at the beneficiary level. So that's why when we are talking of literacy issues, inclusive issues, we should also talk not only of a branch issue, which I told in the past session, we should talk of also regulatory literacy. Even if it may hurt the intellectual sentiment, but you see, like if Jayadev commits a mistake as fountainhead of the Dharma, obviously you imagine those who are followers of Dharma, how much of deflection will be there. I was financial advisor to the regulator of a country, even now I continue. I found they had made some provisions which grossly contradicted even Basel provisions. Then I told, sir, how do you do it? Na Sultan has said. Then I met the Sultan. I told, sir, you know, this will have impact at the grassroots. Nobody told me. I said, because I am used to say. whatever I say is the rule of the country. So I should be educated. So similarly, all the knowledgeable people, they will be rational if a properly coaxed dialogue can be put to them. So that's why the issue not only of India, of many other countries, is that we do not have a properly coaxed dialogue system, and we always top down. We are always top down. There are advisory committees of every regulator. I have been at least in the advisory committee of each regulator, all the 4 regulators. We give advices, but nobody listens. And ultimately, it affects the operations. And when there is operational lapse, then all of a sudden everybody wake up, and there are knee-jerk error, there is pass the blame. So that's why the main issue, though there may be operational issues, there may be fraud issues, there may be lack of implementation issues, but the main issue is the issue of talent and issue of ego. These are to be first addressed, to address the grassroots level problems. Anyway, this is by way of only introduction. But let us come to now the issue, because now my predecessor, he talked of some very nice field level issues of India. Let me, since it's a challenge, let me tell you about the challenges, not only for banking, because banking is not the only window open. Banking, insurance, assets, as also pension. These 4 things, they actually together create the financial firmament of a country. Of course, I include now, by assets I say commodities, finance and everything. So, what happens? The world has got a stock, has got a flow. The flow is reflected in the growth, and the stock is reflected in the classification of the countries according to their financial stature. But you know, Krishnamurthy once told it beautifully, people do not become rich from their own money. They become rich by capturing the future, because all money is in the future. You see, obviously, if regulation is such that it is laissez-faire, free for all, without any spanning, Ambani will get more money, and the poor person will only earn at best wages. So, to create a regulatory condition for distributive effect requires lot more hard work than only going for changing over from a rule-based to principle-based, or giving punitive measure to few companies who commit mistakes. These are routine work of regulator. The real work of the regulator is to influence the future of the country and to distribute the future. Because past, the poor is known to be poor, the rich is known to be rich, and the regulator has no role there, except in doing the routine work. The regulator and the people in the operations, people in the making of the strategies, even I include the political governance system, all these people, they should create the principles or regulations or laws or acts or whatever it is, to see that future is distributed. And how it is distributed? If America grows at the rate of 2%, and India grows at the rate of 8%, India is poorly growing, because the base is small. America's base is so big that even 2% keeps them, you know, at the rate at which we are growing, very fast we are growing, at the rate at which we are growing, by 2030 in 2030 will be still 1/3 of America, despite America growing at almost 1/4 of our rate. And at the rate at which we are growing, you will be happy to know, by 2030, we will be as big as China today. And China will be 3 times more than what China is today. So that's why when we talk of capturing the future and distributing the future, if we do not do it, then what will happen? The issues will get more acute. Obviously, the Gini index of India, if you know Gini index, that is the way wealth is distributed. It doesn't require any rocket science to know that Gini index of India is very poor. Because you have recently heard 1% of Indians capture 77% of India's growth. So that's why the issue is that, you know, already Ambani has captured 50% of the India's media, because if I got money, I find which one is influencing the public opinion. I'll capture that opinion. So similarly, if Ambani wants, he can capture whatever is sellable. If regulatory is also sellable, he can capture. So that's why it's not a question of only wealth. It is a question of future also. The future is trapped, and that is the biggest issue of the world now. The biggest issue of the financial world is that no regulator, no political governance system thinks of distributing the future. At best, they think of distributing some social welfare of today, give 1 rupee rice. With doing that, you cannot address the social tension which is brewing for tomorrow, the civil war which may come. So what if somebody madly told that something will happen to India if India doesn't follow this? Of course, that may be madness, but it's not very far from truth. Because, you know, this 1 rupee rice or distributing social booties is ensuring against social tension. It is not a goodwill, it's not a good work done for the poor. Because the poor will not revolt. Let me ensure against social tension by giving some premium. I just give a small premium and cover a big risk. That is what is happening. And coming to financial system itself, you know, India's all parameters of India's growth, you know, they say that a country is good if its insurance growth is as good as its GDP growth. That is the fundamental equation which Geneva papers they put. All white papers they say if GDP growth is parallel to the insurance growth, or insurance growth is parallel to GDP growth, the country is in right hand, because it's commonsensical. GDP growth, there will be assets, and they need risk management protection, so that should be commensurate growth. But that is, if the literacy is there, inclusiveness is there, if there is a proper distribution, proper sensitization, proper knowledge. If in a country there is a stock of GDP, India's stock of GDP, you know, will be around whatever is India's stock of GDP. You know, our insurance is not correlated to that stock of GDP. And the way GDP is growing, our insurance is growing higher than that, much higher than our GDP growth, in fact, more than double. So should we be happy? We are more than double because we are compensating for our grandfather and our great-grandfather's mistakes. And that's not good enough. Why it's not good enough? You know, when top 15 insurance countries, India is considered GDP stock-wise, India will become number 3 by 2030. But in the top 15, India is not considered as an insurance power. I have headed many of the top insurance companies, top insurance, service providers. I have seen they are number 1, but they are considered insignificant in the world platform. So, our issue is that we are patting ourselves for the growth we record, which is little higher than the average at many times, without having an understanding what is our required rate of growth. Which growth rate will give us the power to commensurate ourselves with the GDP we will be possessing. Because why it is so? Because GDP we will be possessing is highly esoterically mapped to a few pockets. And, you know, if there is a Patal Ganga, if there is a flood, Reliance has no issues because they have insured, they call it fronting basis, they have insured it globally and they get back their money pie by pie. They have no loss. But if a poor person, he loses his cattle, he loses his capital. And on the date he has purchased cattle, he thinks that God is with me and nothing will happen to me. I am son of God, nothing will happen to me. It will happen to him, not to me. Because we become fatalist to the safer side because we don't have financial literacy, financial knowledge, that how the future will be distributed. When I talk future distribution, it's not only future money will be distributed, it is future agony will also be distributed. Future agony is well distributed because I don't take care, but future money doesn't come to me. So I request all people who are doing such great social service of spreading financial literacy to spread also not about the product that is being palmed off, to teach about the situation, not only product. And situation and the will be yet to be situation. I tell you, the countries which have done this, all the Nodi countries, I give you example of Nodi countries. The countries which have done this, now every country is looking at them not only for finance, but also looking at them for entrepreneurship or looking at them for education. In fact, the other day, the RSS chief, Mohan Bhagavat, had called some of us, mostly educationists. He was telling that we should follow Finland's education system. I told sir, when my turn came, I told sir, Finland, does it compare anywhere with India? What is the population size? What is the geographical size? What is the problem size? And how much of future has to be managed? So, kindly look at India's issues and find out if there is a geographical territory which can be mapped to India, not these countries like Finland or even Netherlands. In fact, a lot of RSS workers were sent to Finland to imbibe the Finland spirit. And I tell you, there has been a reversal of RSS thinking about Finland and India. So, what I say, however big the person may be, however powerful the person may be, if those who are literate and want to advocate literacy, not only they should bestow or distribute literacy, they should also advocate with the right people who are spreading illiteracy, who have got power to spread illiteracy. And our main problem is that we do not stand on our spine many times, or we stand on our spine only for our understanding. We do not stretch our understanding. That is our India's, just called Sanskriti, that don't question the boss. You know, boss or whatever boss. So that's why when you told about issues and challenges, there are many issues and challenges, they cannot be all discussed here. But the cardinal issues and challenges, that doing what you are doing yesterday good is no longer enough. Yesterday you were very good, and traditionally whatever your predecessor done, you have done much better. That is not good enough. You have to find out what is to be done for the redistribution of the future. That is number one. Number two, we are talking of financial wealth creation. Ultimately, what is financial? Either we go for wealth creation or we, in fact, in the sandbox system, Reserve Bank of India itself has made 3 classifications of role of financial inclusion. I like the 3 classifications. Protect the whatever is there, first protect it, like we say, first survive, then sustain, remain stable, then grow. So very simple steps. Similarly, we have to find out that we used to, at ASCII, I used to teach a case study. So people used to, in fact, most of Chief General Manager, then Chief General Manager of Reserve Bank of India had taken that case study, because Bimal Jalan Sahab had asked me to give that case study to each Chief General Manager. So they were to go to level 1, level 2, level 7. I tell you very honestly, only 2 people had gone to level 3. Most people had faltered in level 1. So what is it? That case study was known as People's Express. You see, there will be, it's a beautiful case study, even now it is available even in the internet. You know, you play regulatory game, and most of them are enamored with the end result. And the end result shows that you are the best. But when you back calculate, you find you are died in the first level. Like giving a dead body a medicine to make it look robust. So, if you are focused on the end result, and only if you survive, you will enjoy the end result, na? But you are already dead in the first level because of your focus on the end result. So that was what is called People's Express. Anyway, details you can go through. What I want to say, that we must, of course, Mahatma Gandhi had made it too lofty. Ends should be good and means should be good. He had made it too lofty. But nowadays, what is it? Shortcut should be good. Means it should be shortcut. So this should, somebody told about the grid. You know, how to contain it? Can it be contained in a financial way, or it can be contained in a social way? The merit lies in little bit of mechanical finance and a lot more attitudinal re-anchoring of the society. If we can't do this, whatever knowledge, literacy, opportunities we get, we will create social instability. Thank you.
Thank you, Dr. Mishra. Any students, you have got any questions on? Mishra, welcome to the dais, and
thank you, Mr. Mishra, once again. Now I'm here, and I am keenly aware that you must be extremely hungry by now, and we are running. So I'll try to shorten my remark as much as possible. Since this conclave is about financial education, so I would be dealing with the subject of capital markets from the point of view of perhaps what you may be facing as a question when you go out and you teach somebody or you take a session on financial education. because in financial education, now we always have a motto that everyone who attends a seminar on financial education, he becomes an ambassador and he will be spreading more financial education further. So I have designed my remarks as a series of questions about securities markets. The first and most important question which anybody would have is whether I should enter the securities market. So that is the question number one, because the penetration of securities market in Indian system is extremely low. So the question to ask is that should I at all enter the securities market? So one of my senior colleagues, he used to say something like this, that look here, there are various markets and various needs. The first need is to live. So if you have to live, you must have a bank account and you must enter a bank. Otherwise, it will be difficult to survive in today's environment. You will not be able to make transfers, you will not be able to make payments. So it is necessary to enter banking in order to survive, in order to live. Then the second thing, what he said, is to cover the risk of dying, you must enter the insurance market. That what happens to my family, what happens if I die, what happens if my asset dies. So you must enter the securities market. And when should I enter then, and why should I enter the securities market? And that is to cover the risk of not dying. Supposing you don't die, you keep on living for much more time, then what happens? That normally your assets, your fixed assets or your financial assets will be overtaken by the general inflation levels. So you must enter the securities market in order to cover that risk. The second question which I say, that when should I enter the securities market? So one of the given wisdoms is that you should enter the securities market when everybody is selling. So if the market is going down, so this is time to enter. So this is a kind of a funda which is given many a time, because the assets are priced at their lower than normal level. The only thing I would say in response to this is this, that over the last 400 years, when the securities market has existed, nobody has been able to time the market. It is a kind of an impossibility. You cannot time the market. So if you think that now the market has fallen further and think that now the market will rise, the market will surprise you by falling further and further and further. In the long run, it might go up again, but what we say that in the long run, everybody is dead. So if you are not able to survive, then what use your market is. So if you enter the market, then you must enter the market when you feel that you have got some spare money, which you can risk, which you don't need immediately, which you are not dependent upon. So that is a time to enter the market. Enter in a small way, don't enter in a big way, but do enter and be consistent in your investments in securities markets. So if you are entering the securities market, you must enter with certain amount of risk-taking capacity. If you do not have any risk-taking capacity, please do not enter the market. Now the third question which is often asked from security markets is this, that is it too risky? The plain and short answer is yes, it is risky. But when I say it is risky, it means two things. It means it is volatile. It can go up, it can go down. So, if you have got an upside, you have got downside, you have got an upside also. Secondly, security market is not only equity markets. Securities market is much more than equity market. It's a mutual fund market also, it is a debt market also, it is alternative funds market also. So there are different shades of risks are there. And there are different type of risks associated with the markets. So, on the other hand, if I ask a counter question, yes, securities market are risky, of course, then I'll ask that, can you tell me something which is not risky? You tell me a single investment which is not risky. Perhaps you may say the government securities are not risky, because that is called the risk-free rate of interest what you get from the government security. But is it a fact? No, it is not a fact. There is only one risk which is covered in the government securities, which is credit risk. And credit risk says that your principal amount will be repaid along with whatever interest is told to you. Now, how the government makes it risk-free? Because they have got power to print money. So they can print the money and they can always give you back your money. But the risk lies that, look here, that the government will keep on printing the money, inflation will keep on going up and up, and when you had deposited or purchased the GSEC for 1 crore rupees, and now you cannot really survive for a few months on that. So, even the government's ability to repay comes out of their power to print money, and since they can print money, that will automatically erode the value of your money. If you don't take such an extreme example, you just buy a government security and keep on watching whether you want to sell tomorrow, it will have an interest rate risk. The value may pretty well go down. So there is no product which is absolutely risk-free. Are the bank deposits risk-free? Nowadays, the misinformation has been done away with when people thought that bank deposits are guaranteed by the Reserve Bank of India or government. Now everybody knows that this is not the case. These are not risk-free products. All you are covered is the deposit insurance, and that's about all. And nobody gave any guarantee to anybody that your bank deposits will be repaid. So, when we are entering the securities market, we must know that yes, the securities markets are risky, but we must also counterbalance with this view that almost every financial product is risky as well. It's only the nature of risk which varies from one place to another. The fourth question which I'll answer, that if I am entering the securities market, where should I enter? The general point of entry, which was a kind of given wisdom, was that we should enter the IPOs, because IPOs are generally at a lower price, and you will be definitely on an average you will be rewarded. 1 or 2 IPOs may not do well, but you will be definitely rewarded with the IPOs. This kind of a thinking came out of a historical aberration, which was the FERA dilution, that the foreign companies, they were forced to dilute, and since those were the days of the controller of capital issues, so by law, the dilution happened at a very low price, so people made a lot of money. So actually, as a matter of fact, when you are entering into an IPO market, you are investing in an entity which is absolutely unknown entity. And to have even some slight idea of what kind of entity it is, then you might have to plow through something like 400 to 700 pages of closely printed IPO document, which perhaps nobody reads, leaving aside the person who has drafted that thing from the merchant banker and the one junior officer in SEBI. Leaving aside these two people, I don't think anybody reads the IPO documents. So IPO is perhaps not a extremely safe place to begin with. Comparatively safe place to begin with is the secondary market, the share market. But share market also is a kind of, your risks, you really cannot know that which kind of a stock I am getting into. So now it is a kind of a accepted wisdom in the securities market that for a new entrant, the correct place to enter is a diversified portfolio, and that diversified portfolio for a small money can be a mutual fund only. And in order not to time the market, you should enter into a systematic plan. The fifth question, which I would ask is this, that what kind of products should I buy? There are a lot of kinds of products. For example, one of the speakers were telling about endowment policy and term insurance, this and that. You should buy term insurance, not endowment policy, so on and so forth. If you go to any portfolio manager, he'll tell you a lot of products. And then he'll say that, look here, sir, I know, I am a financial advisor of yours. I know your needs. I will design a product for you. That kind of a thing, and then you think, yes, a tailor-made suit is always better than a suit which is bought off the rack. So I should buy a tailored product. So my answer to this question is this, that what kind of product I should buy. My answer is generally, I should be buying a product which I understand. If I don't understand a product, I should not buy it. And buying a simple product, a straightforward one risk factor or two risk factor product itself is very complicated. And when you club lot of products into one single product, then it becomes even more less transparent, and it will be more risky. For example, the issue about the endowment policy or money back policy, those kind of a thing, where an insurance product is bundled with an investment product. Now, it is much more difficult to evaluate a bundled product. So my recommendation would be, if you want both the advantages, then you should go for two separate products. One should have a term policy for covering the risk of dying, and you should have a separate mutual fund or some kind of those investment to cover the risk of not dying. You would know how much money you are putting for each. You would be very clear, and you would also be able to track the kind of returns you are getting, and you'll also be able to track whether I am getting good returns out of it or not. But this is a very theoretical advice for the reason that you are many a time encountered with a product, and especially this advice is not for everybody, but for those people who happen to go to the portfolio managers or some other more complicated products. Then please just insist on one thing, that ask him to say in clear terms or give in writing that the product does not contain a sold option. That some of the products which are sold, they look too good to be true. Everything is so nice. But what happens somewhere hidden is a sold option where you are taking unlimited downside if certain events happen. So this is the last one, which I had to say, and this is, securities market is a large area where there are hundreds of gurus, so many textbooks. It's, I have told you whatever I thought. Thank you so much.
Thank you, Saranji. So nicely explained the intricacy of the capital market and the options with the investors. So I'll request Mr. Mishra. I'll just make a short introduction. Mr. Mishra, he comes from IDBI Capital Market, Capital Securities. He's a deputy vice president. So exclusively he has come to share his thoughts about capital market. This area is so vast and dicey, it required a lot of challenging things. And I request Mr. Mishra to interact, please.
Well, thanks a lot, sir. It's being a privilege and absolute honor for me to be part of this conclave. Somehow, the interaction, whatever I could hear from the morning, it's like 18 years of my career coming through. There was a flash kind of movie going on. Some distinguished guest was sharing his experience about someone was having 60 policies of insurance and some other things also. So, but before, I would not be taking much of time, just few basic things I would like to touch. Well, we are having a population of 135 crore. So that is what India is all about, right? Now, out of that, only 6% penetration we have in equities market. So out of 135 crore, about 40 to 50 crore people are, accustomed with the equities in India. That defines and that, surely tells us the opportunity of equities, how and, how we can go further. That we'll discuss. When I come to insurance, the penetration is a meager 3.5% of entire 135 crore. So that gives us an ample opportunity to, to go aware, make people aware, make people feel safe with their life, and make them grow rich. And that is what, we all have been doing in our life, and, we all have been starving to. Now, few things first. When what Prashant sir was sharing about, that when it comes to equity, timing the equity market is important. But I don't know, I have not known even a single human in entire 18 years of my career that who could come and comfortably tell us that, yes, I have been able to time the market. So it cannot be done. And let us give it a, keep it there. Now, what to do, when I have some spare money, how to park that money so that it can grow further and I can build some corpus for my, future, I can create some kind of wealth. If I have the understanding of the market, that remains the basic thing, that if not, then I need to acquire, some bit of